Welcome, my name is Vishal Tekshilani. Today I'm speaking to Alan Kohler, the Editor-in-Chief at InvestSmart, one of our content partners. Alan is going to explain Earnings Season 101. What is earnings season? Why should it matter to you as an investor? And how you can prepare for it. Alan, thank you so much for being here today. How are you?
It's a pleasure. I'm fine. Thanks, Vishal.
That's great. Alan, I'm sure one of the questions that we both get asked very frequently from newer investors in particular is, what is this earnings season business? Can you explain it in a nutshell?
Well, Australian companies have to report their profit, their financial results every 6 months in Australia. In America, it's every quarter, but in Australia, it's every 6 months. And they all do it at once. They tend to all have the same year end, which is June the 30th. And that means the 6 monthly report comes out on December the 31st. And they generally take 3 weeks to a month to get their act together, to get the financials together, and then they publish them generally during August and February.
August and February. And so August and February, that's when that's the two blocks of time when a lot of companies report. But correct me if I'm wrong, there's also two smaller clusters, May and October/late November, when certain banks report. Is that right?
Yeah, there's some companies, some of the banks have a different reporting season. Absolutely no idea why, but they do.
Okay. So from an investor's perspective, why should it matter? Companies post their announcements. They say all these things like, our cash flow was this, our margin was this, our net profit was that. Why does it matter to investors?
It's interesting, isn't it? Because the perfect market theory would tell you that the market should know all the time how these companies are going. In fact, the market doesn't know. The market's waiting to find out. And so basically shares are priced according to the future earnings flow of the company. Analysts and investors try to figure out what a company's worth now according to what the cash flow in the future is going to be, and so they tend to assess that according to what this year's profit is, and then sort of extrapolate their profit into the future. Okay. And so it does matter. It does tend to influence how they value the company now.
And it's a pulse check on the financial health of the company, right?
Well, of course.
Yeah. Okay. So often when a company announces its earnings, we see those results covered in the media. And the media will often reference the result and say that, BHP, for example, or whatever company, it either met its expectations, it exceeded guidance, or it didn't beat the market's guidance. Who sets these market expectations, and why do they matter?
Well, there's two ways that the market expectations are set. One is that the analysts generally publish their forecasts of profit for the next few years. With price targets, and so that's really what we're talking about with market expectations. And Bloomberg and other services tend to publish what they call consensus forecasts, and so they take all of the analysts and they average their forecasts over the next couple of years, and they go, here's the number that this company BHP is expected to earn by the market in next year and the year after and the year after that, and what that is simply an average of all of the analysts. In addition to that, the companies themselves tend to often, not all the time, but often publish guidance, what they call guidance. So they'll put out an update a few months before the results are due out to say what they expect themselves. And at that point, the analysts all go back to their spreadsheet and change their thinking or do or not or whatever. And at that point, when that happens, that's when the share price often moves quite a lot, because the analysts have to adjust their thinking about what the company's doing.
Okay. So when a company announces its earnings, one of the things that can happen is that its stock price, like you mentioned, it can also move adversely at the time of earnings. It can go up a lot if it smashes the lights out. It can go down a lot if it disappoints quite deeply. From an investor's perspective, something I've always wondered about is, if a company had good results, does that mean you buy more shares? Conversely, if it's a bad result, do you say, you know what, I should get rid of this stock? How should an investor approach it?
Well, look, I think there's a couple of things to think about. One is that if a company disappoints its own guidance or doesn't meet its own guidance, you've got to wonder what's going on in their heads.
Yeah, okay.
Okay, because it's their own guidance. So what are they doing? Don't they know what's going on?
Yeah.
But even with analyst expectations, they know what the analysts are predicting. If the market is out of whack in terms of what they're going to do, they really should be guiding them to be different, to get the right answer. So there's no excuse, in my view, for a company to either drastically exceed or or underperform
Yeah.
on expectations. And that's really something the market gets and agrees with, because if there is some sort of drastic over or underperformance, the market goes crazy, as it should, because, as I say, there's no excuse for that.
Okay.
I mean, because they do have an obligation, apart from anything else, apart from just being sensible, they have an obligation to keep the market informed. There's a continuous disclosure obligation on them, and so therefore, if something's going on that the market should know about, then they should tell it. But it's interesting, the three biggest declines in the market in January on the ASX 200 were Costa Group, Challenger, and ResMed, right? All of them big declines. All of them because Challenger and Costa because they put out trading updates that were that guidance that showed that they weren't going too well. ResMed actually put out a quarterly that didn't meet expectations, and so the market in those three cases was shocked. Investors were surprised,
right?
And you know, I mean, I've always gone along with, you know, my bosses in life. Never surprise them.
Right.
Never surprise your boss. That's the.
It's good advice.
That's good advice, Vishal. Just bear that in mind. Never surprise your boss. And company managers and directors, their boss, are the shareholders.
Yeah.
And don't surprise them.
Okay. Okay. So, taking things to a high level, how do investors actually access earnings announcements? Where can they get that information from?
Well, apart from the media, obviously. The thing is that not all companies are reported in the media. So if you're an investor in a small company, it'll probably get ignored. So you really have to keep an eye out. The thing to do, I would suggest, is to have a Google alert. Hope that somebody somewhere reports it on your companies. Other than that, go to the ASX website.
Or a NAB trade account where an ASX announcements are fed.
Exactly. Took the words out of my mouth, Vishal.
Okay. Okay. So yeah, you know, companies' websites, getting a share trading platform, they can access information that way. And from your perspective, how do investors actually prepare? How do you prepare for reporting season? Like, you know, there's a preparation element to it. What do you do? You've got all these earnings announcements that are going to come. How do you get ready?
Yeah, I put a big thing of line of sandbags up. Get the tin hat out.
Yep.
No, just kidding. How do I prepare? I just keep an eye on all the stocks that I own.
Yep.
And the thing is, companies that are vulnerable to surprises and to falling a lot, like Costa and Challenger did, and ResMed, the companies that are vulnerable like that are those that have a high PE ratio.
Yep.
So find out what the PE ratio is. If it's like above 20 or 25 or 30 or something like that as a PE ratio, then that means that the market is expecting a lot from the company's profits. You know, there's a lot of built-in expectations. Now, a lot of the time, those expectations are met. It's fine. But, you know, if they've got a high PE ratio, a high price, high valuation, then that means they're a bit vulnerable.
Okay. Okay.
So that's the thing to keep an eye on. And if you find that your stock that you own has gone up a lot and it's now looking quite expensive and you're a bit worried about things, that, you know, maybe things aren't going too well, you might want to just lighten off a bit.
Okay.
But it doesn't always happen. For example, Kogan was expensive to begin with. It's one of the best performers this year because it put out a trading update that showed that things are going well. And so an expensive stock in that case became even more expensive.
Wow. Okay. Okay. All right, Alan, thank you so much for your time and for sharing your insights and tips on reporting season with our investors. Really appreciate it.
Not at all.
I hope you enjoyed this video. Now, please remember at NAB Trade, we do provide useful information and tools to help you prepare for reporting season. So videos like this, we publish an earnings season calendar, and you can also access tools like getting SMS and email notifications via our alerts feed, so you know when a company announces earnings. Please do check out our website for more information. Good luck with the reporting season. My name is Vishal Tikstani, and I'll see you next time.